Markets are absolutely melting down. Starting off with Bitcoin, we can see, guys, we are down a whopping 75% in the past 4 months alone. No, you heard me correctly, that's 75%, but it's not just Bitcoin. The Nasdaq 100, the 100 largest tech companies around the world, is down a whopping 33%. Okay, that's massive. And guess what? Not just the Nasdaq, it's the S&P 500. The 500 largest companies around the world is down 25% in the past 5 months. That is $15 trillion of wealth has been absolutely wiped off the equity markets around the world. But it's not just equities, okay? Typically, your safe haven bonds is supposed to do well when equities crash, right? That's the 60-40 trade. But guess what? The bond market suffers its worst quarter in decades. Assets all around the world are absolutely cratering. And it's not just asset prices. It's also central banks. You've got the Bank of Japan absolutely on the brink of collapsing. Okay, guys, this is the third largest currency around the world on the brink of collapse, and the second largest currency around the world, the euro, okay, headed by this burnt lobster, Christine Lagarde from the ECB, they're facing severe risk of disorderly financial markets, okay, and they actually had to hold an emergency meeting just earlier this week. So as you can tell, there's a lot happening in financial markets, and in this video, I'm going to break all of it down, and guess what? There's one thing that's actually causing all of the carnage, and I'm going to break down what that thing is today, and most importantly, how you can protect yourself from these markets if they do continue crashing. And if they do continue crashing, where's Bitcoin going? This is a Bitcoin channel. So a lot of people say, hey, you look, Bitcoin's going to 14K, 12K, 10K. I've even heard people say Bitcoin's going to 3K. So in this video, I'm going to tell you where I think Bitcoin's going and whether it's bottomed or not. Let's get straight into it. So as we touched on in the introduction, everything is crashing. Bitcoin, tech stocks, bonds, equities, and even our favorite central banks are crashing. And everybody wants to know why, and it all comes down to what you're probably sick of hearing about: inflation and interest rates. So we're going to break that down for you guys today. Inflation is hitting 50-year highs all around the world, and that is forcing central banks all around the world to raise interest rates. They have to pretend as if they care about you guys, and they have to pretend as if they're going to raise interest rates to fight inflation. Now, as we can see by this chart here, it's not just the major central banks. Even the central banks in emerging markets like Russia, Chile, Brazil, India, they're all suffering from 50-year record-breaking inflation, and they're all trying to raise interest rates. Now, in doing that, that is obviously causing absolute chaos in financial markets, but everybody's asking why? Why does high interest rates cause my technology stocks to crash? Why does high interest rates cause my Bitcoin to crash? And it's all got to do with the fiat Ponzi, okay? We are living in the largest debt bubble in human history. People hear me say that a lot and they scoff a little bit. They say that's a little bit of hyperbole, Luke, but it's not. If you simply look at the debt levels all around the world, we are literally at 1,000-year highs, and that is why you've got interest rates at 5,000-year lows. Okay, so here's a little chart of US debt, and you can see that it's actually higher today than it was in the World War II era. Okay, so debt is the problem, and as you can see over the past 50 years, every single time that our favorite central bankers have tried to raise interest rates and normalize the fiat Ponzi, you can see that we've created an absolute financial crisis. So in the 1980s, we had the Latin America debt crisis. In 1987, we had the Black Monday stock market crash, where stocks crashed by, I think it was 27% on Monday in the one day. In the 1990s, we tried to raise interest rates, and you can see Russia and Asia both had a debt crisis, as well as long-term capital management. And then obviously in 2008, we tried to raise interest rates, moving into the housing market bubble. But you guys can see the story. Every single time you try to raise rates and normalize the fiat Ponzi, we run into a financial crisis, and that is what I think we're running into today in 2022, as our favorite central bankers are world once again trying to normalize interest rates. Now, let's have a look at just how dire the situation is. A lot of people say, but why does high debt always end in chaos? Why does high debt have to end in inflation or a massive collapse? Are you just pulling those figures out of your ass, Luke? Is that just an opinion of yours? Well, it's actually not. It's actually just simple mathematics. This report here comes from a hedge fund called Hirschman Capital, and they actually studied 52 countries for the past 250 years, and they analyzed what happened to countries when they reach very high levels of debt. I'm just going to highlight the key takeaway here. They said since 1800, 51 out of 52 countries with government debt greater than 130% have defaulted. They either default through restructuring, devaluation, high inflation, or outright default, okay? And the report essentially goes on to say, when you have a money printer, it is much easier to choose option number 3, okay? Devaluation, or option number 2, I should add, high inflation. This is how governments get out of this enormous debt bubble. When you reach 130% government debt to GDP, most governments and most central banks choose the most politically palatable option to default on that debt, which is through simply devaluing the currency and paying back the debt with the devalued dollars. When you have a magic money printer, that is the most politically palatable option to take. Sorry about my French there, guys. But, so where are we today? If 130% is the Rubicon, and if 51 out of 52 times we've reached that 130% number, countries have defaulted on that debt within 15 years, where are we today? Well, let's look back at the chart we brought up earlier, and you can see all the major countries around the world are well and truly around or over that 130% number. So Japan, 257%. The US actually hit 139% in 2021, and we've actually just fallen down to about 120% now. So speaking of Japan, in that Hirschman Capital report, a lot of our favorite Keynesian economists, they will say, look, we're entering into this new era. We're going to call it modern monetary theory, okay? That's what the Keynesians say. They say, look at Japan. Japan hasn't defaulted on their debt, and today Japanese debt is at, 256%, guys? That's what it is, 257%, sorry. Now, these Keynesians point to Japan and say, look, this is how you deal with debt in the modern age, okay? This is modern monetary theory. We're going to go through this environment where central banks can just buy government debt into perpetuity, and they're never going to generate inflation. That's what we've been told. And even lots of very famous economists over the past decade have said, yeah, even the US, we can just simply turn Japanese. Well, guess what, ladies and gentlemen? It looks as if the Japanese MMT experiment is finally coming to an end, okay? Their yield curve control program is finally breaking down, and guess what? Japan is suffering from enormous inflation. I'm going to put a chart on screen at the moment. So the Keynesians told us we'd never get inflation. We can just simply print money like Japan and buy up an endless amount of government bonds, and now all of a sudden government debt doesn't matter because Japan is the one country out of the 52 countries who haven't defaulted on their enormous debt yet. But guess what? The Keynesians were wrong, and we are actually seeing spiraling inflation might come for Japan today, okay? So Japan is finally getting inflation. The Keynesians were wrong because printing money at its very basic and simplified form will lead to inflation in one way, shape, or form. And you can see here, 2% inflation seen for the first time since 2008 in Japan, but I'm here to tell you it's a whole lot worse than 2%. If we scroll down, I want to show you this chart here. This is a chart of the producer price index, okay? So the PPI, the producer price index, is a leading indicator of CPI. If the producers are paying 10% inflation, like they are in Japan, that is a leading indicator that inflation is going to come hot in the CPI index, okay? Now, a lot of people say, why is Japan doing MMT? A lot of people say, what the hell is yield curve control? So we're going to break that down a little bit here. Put very simply, yield curve control is, like it says, they're trying to control the yield curve. So because Japan has this enormous amounts of government debt, they have 250% government debt to GDP. Now, normally, like we said just a minute ago, once you get over 130%, you normally end up defaulting on their debt. The Keynesians say, well, how about we just print money and buy bonds so that we can artificially suppress interest rates below a certain level. So then they think, in theory, that the government is never going to go bankrupt because the government doesn't have to pay high interest rates on those government bonds. And that has been the case for the past 8 years. For the past 8 years, the yields on the Japanese bonds have actually stayed relatively low, okay? And the Japanese government has gotten away with their central bank printing enormous amounts of Japanese yen and buying those government bonds without causing inflation until the past 3 or 4 months, okay? You can see here I have a white line on the screen and we're actually looking at the yields on the Japanese bonds. And you can see that these yields are spiking above the 0.25% target, okay? They want to peg yields on these government bonds below 0.25% because if those interest rates start rising any higher to say 0.5% or 1%, all of a sudden Japan, the government of Japan, who has a debt bigger than 250% of the GDP of Japan, they'll actually have to start paying enormous amounts of interest on that government debt. So that gets back to this chart here. Japan has enormous amounts of debt, and all of a sudden the Japanese central bank, the BOJ, is having to print enormous amounts of yen. So let's take a look at this chart here. You can see this is measuring the gap between the JGB futures and the underlying bonds. And again, 2022, that is absolutely exploding. Zero Hedge put it well. The world's second largest bond market, which is $10 trillion in size, is blowing up. That is exactly what we're watching. This little chart here is showing the amount of bonds the Bank of Japan is having to purchase to defend that yield curve control cap. You can see it is absolutely exploded. This looks to be about 500% higher than just earlier in the year, okay? The Japanese central bank is having all sorts of trouble trying to subdue the bond market, okay? Preston Pierce has put a nice little chart here, and he's showing the hourly volatility on the Japanese sovereign debt, and this is across all durations, not just the 10-year JGB that we just looked at. This is all the bonds. This is 3 months, 6 month, your 1 year and your 2 year bonds. My good friend Drew put it well here, the collapse of a currency in real time. That is what we're watching. We're watching increased volatility in bonds, and it's not just in Japan. As we mentioned in the introduction, this problem is also facing Europe. But before we get into Europe, we should probably have a look at how well the Japanese yen is faring against the US dollar, okay? So we all know that the US dollar is losing somewhere around 15% of its value every single year, okay? If you go look at shadow stats, like we've looked at many times on this channel, real inflation is not 8.6% like Sleepy Joe Biden is telling you. It's actually much higher. It's much more like 15% if you use the same metrics and the same inflation baskets that our own governments used back in the 1980s. But of course, we know they manipulated those baskets on many occasions throughout the past couple of decades. So the US dollar is losing 15% of its value, and guess what? The Japanese yen has lost about 25% of its value against the dollar over the past year, okay? So I've actually zoomed out a little bit further. You can see since the beginning of 2021, the Japanese yen has actually lost 34% of its value against the dollar, which has lost 15% of its value last year. So to put it very simply, the yen is going down the toilet trying to defend the Japanese bond market. That's what we're watching. We're watching Japan absolutely melt down, and we're watching modern monetary theory die in real time. And it's a beautiful thing, honestly. It really is. But like we mentioned, this isn't just isolated to Japan, okay? Japan is the third largest economy around the world. So for this to be happening to Japan, it's a big issue. But let's look at the fourth largest economy around the world. And they are obviously led by the burnt lobster herself, that is Christine Lagarde. Europe is facing severe risk of disorderly financial markets, okay? So the ECB recently just had to call an emergency meeting literally 6 days after they had their normal scheduled policy meeting that they have every month. The The markets changed so much in 6 days that the ECB had to hold an emergency meeting because the Italian bond yields absolutely soared. So what happened was the Fed came out and they said, hey, guess what? We're not just going to raise interest rates by 0.5%. We're actually going to raise them by 0.75%. So if we go back to the chart that we actually started this little video on, you can see that the US interest rates are much, much higher than the Japanese or the European central bank interest rates. They are down here at negative 0.5 and negative 0.75. That is because the ECB, so Europe, as well as Japan, they're in a far worse situation than the United States is. So the United States can handle interest rates being at 2%, whereas Europe and Japan cannot handle interest rates above 0. That's how much of a Ponzi scheme they're running over there in Europe and Japan. So obviously, this is kind of highlighting the fact that yes, the US dollar is really bad, but other currencies around the world are actually in much worse shape than the US dollar, and that is because the world runs on US dollars for now, okay? Sounds a little bit counterintuitive because everybody says the dollar's going to 0, and it is, but it's going to be the last fiat currency to go to 0. And everybody hates to hear that, and they all call me crazy for when I say the US dollar is going to be the last fiat currency to hyperinflate, but it all comes down to simple gravity, simple economic gravity. The world runs on US dollars because of this thing called the petrodollar and the eurodollar system. But before I wrap this video up and I explain what those things are and how they relate to markets crashing today and give you guys some takeaways for picking the Bitcoin bottom, let's quickly hear from today's show sponsor. Firstly, you guys would know all about the BitBox02 Bitcoin only hardware wallet. You guys can get 5% off one of those if you use a promo code Bitcoin made simple. Getting your coins off exchange is the most important move you can take today as you watch exchanges like Celsius, CoinFlex, and even Voyager all halt withdrawals and say, guess what? Your Bitcoin is not your Bitcoin. So go and get yourself a BitBox02 hardware wallet from Shift Crypto. Again, you can use the promo code Bitcoin made simple, no spaces, and you can get 5% off. Okay, now let's quickly hear from today's main show sponsor, who is Hodling Apparel. Massive thank you to today's show sponsor, Hodling Apparel, who is the best Bitcoin and freedom oriented clothing brand in the space. Trust me guys, I've been in the Bitcoin space for around 5 years now, and it's very, very difficult to find some high quality Bitcoin clothing. And like me, the two founders of Hodling Apparel were endlessly looking for more wearable, everyday Bitcoin clothing until they realized they could just make their own, and that's exactly what they've done. As you can see on the screen here guys, they offer a wide range of hats, t-shirts and sweatshirts for every type of Bitcoiner, male and female, whether they are loud maximalists or low-key sovereign individuals. So whether you're headed to the next Bitcoin conference or family reunion, get yourself some gear at hodlingapparel.com to spread the Bitcoin message in style. Today guys, you can get 20% off the entire range at Hodling Apparel if you use the promo code BMS20. So that is BMS20. That stands for Bitcoin Made Simple. And you guys can also get 15% off if it's your first time buying anything at Hodling Apparel. I highly recommend you go and check them out. My personal favorite is the Ungovernable t-shirt. I've got one of those on the way and I'll be sporting it very shortly. But massive thank you to, again, Hodling Apparel. Check them out at hodlingapparel.com. So definitely check out today's show sponsors, guys. They make this episode possible. Now, let's give you guys the takeaways. What can we take away from this episode? Why are markets melting down? It's all got to do with the strengthening US dollar. Yes, I get it. The US dollar is shit. It's losing 15% of its value every single year. But when you measure that dollar against other currencies around the world, we can see every single time the dollar has rallied, it has caused a massive financial crisis. So we kind of briefly touched on this chart earlier. You can see in the 1980s when the dollar ran from 80 on the Dixie index all the way to 170, it bankrupted pretty much all of Latin America because of, again, it's all down to the US dollar debt. Everybody needs dollars. When the dollar rallies and gets stronger relative to other currencies, the debt that these countries have gets more expensive. Okay, again, same thing that happened in this dollar bull market in the late 90s. The Dixie rallied from 75 all the way up to 135, and guess what happened? We saw a massive Asian currency crisis. I'm pretty sure you also saw Russia default, and we also saw long-term capital management absolutely blow up. That's a leverage hedge fund, but that's probably a story for another video. And today the big question is this current dollar bull market finished, or is it just getting started? And is this potentially the big dollar bull market? That is the question I'm gonna answer in next week's video. This week's episode, okay guys, okay, the dollar is rallying. Everybody's selling everything. There's fears of a global recession, and that is why everything's getting sold. Stocks and even bonds. Bonds are getting sold because everybody's scared. They don't know what to hold. Okay, central banks are simply stuck in between a rock and a hard place today. The global economy has a debt to GDP ratio of around 400%. That is absolutely unprecedented. And central banks are simply, as they're trying to raise interest rates, debt markets are selling off, okay? That is the takeaway from today's video. It's very simple in my opinion, guys. All roads lead to Bitcoin, okay? The Fed continues hiking rates. As this little Venn diagram shows, they're going to cause a global economic crisis as the bond bubble bursts, okay? And we're already seeing the early warning signs of the bond bubble bursting. This chart here from my good friend Greg Foss shows credit spreads are absolutely widening in Europe as well as the United States, indicating there could be a little bit of contagion and credit risk going on in the debt markets. And then this chart here shows the illiquidity of the treasury market. It's actually reaching levels of illiquidity that it had in early 2020 when the Fed had to step in and print a casual $3 trillion out of the wazoo. So be on the lookout, guys. Credit markets are freezing up, and you know what that might mean. The Fed might have to pivot, which is the other option on this little Venn diagram, which will lead to high levels of fiat currency devaluation, high inflation, and guess what? Bitcoin's going to be the solution in that environment as well. The big thing that people miss about the Fed hiking interest rates and trying to taper their enormous Ponzi of a balance sheet, people say, oh, Bitcoin's a risk-off asset. It's never going to perform well in this environment. Well, they don't understand that if the Fed continues hiking interest rates, the entire global financial system is going to freeze like it did in 2008. Okay, we were literally hours away from the credit system freezing in 2008. And guess what happens when the credit system freezes? That means you can't get your money out of the bank. And guess what? What's the only asset you want to own if the bank's closed? I would argue maybe gold, maybe guns, maybe bullets. But Bitcoin is the ultimate asset and the ultimate store of value in that scenario. So anyway, I cut this sheep, guys. Bitcoin wins, and trying to pick the exact bottom, good luck. That's not what I'm trying to do. I'm dollar cost averaging whenever Bitcoin is on a massive discount like it is today, okay? Throughout history, that's typically been a great time to be buying Bitcoin when it's down 70 to 80%, okay? As you can see on the screen, guys, every single time Bitcoin's down 70 to 80%, it's typically been a great time to buy. Doesn't matter if you predict the exact bottom or not, you're getting pretty close. Whether 17K was the bottom or not, who knows, okay? Who knows what the price is going to do in the short term, but now is an amazing time to be buying the dip. I hope you enjoyed the video, guys. That's all I've got for you today. If you enjoyed the video, feel free to like and subscribe, and maybe even share it to someone who you think it might actually help them. So anyway, have a good day, and I'll see you guys in the next video.